generate abnormal return of a stock. Okay, so what is a stock split? Now, stock split is, let's say the company has 1,000 shares, and the price, let's say, is $100. Assume they have a 2-for-1 split, all right? Okay, so that means after that, one share becomes 200 shares. For every one share you have, the company replaces it by 2 shares. All right? And the price will drop to 50 because there's no change. This is accounting. This is just accounting change. No real economic value change. Right? The same company, same asset. Just number of shares double, so the market price must be 50% of the original price. All right? That's the theory. That's theory. But in practice, we find that no, when a company announces a stock split, actually the price increased a little bit, more than 50. It's not just maybe 51, 52, I don't know. All right? So that means why this is the case? Because it increased liquidity. How it increased liquidity? Think about it. If you are an investor, you want to buy this company, all right? And you want, well, in a market in North America, one round lot is 100 shares. One round lot is 100 shares. That means if you buy one standard contract, it will cost you, in this case, $10,000. One round lot is 100 shares, and the share price is 100. It will cost you $10,000. Right? Not everyone has $10,000 to invest. Even you have $10,000 to invest, but you don't want to buy just one stock. You want to diversify. You want to, maybe I just spend $200 or maybe $5,000 on this stock and then $5,000 on the other stock, right? You want to diversify. So if this one costs you $10,000 to buy, probably say, okay, I pick another one, all right? But now after the split, one round lot will cost only $5,000 because now the price is 50 after the stock split. So after the stock split, it may increase the number of potential investors. That is, you may generate more trading that provide higher liquidities. So that's the reason why we observe after a stock split and the company's share actually has a little bit higher than, well, what it's supposed to be, theoretically. Okay? Now you may say, okay, how about if I want to buy some odd lot? Yeah, that's fine. You can buy odd lot of 5 shares, 10 shares, 20 shares. But the cost of trading of odd lot share is a little bit higher. There are some broker that specialize in odd lot trading, all right? But the cost of odd lot trading is a little bit higher because sometimes it's difficult to find a seller want to sell 5 shares. But a standard contract of 100 is easy because everyone want to sell has to be 100 shares, all right? So the price you may get may not be as good as a round lot if you trade odd lot, all right? Okay. So that's another reason why, yeah, this is the case. That is, when you have a stock split, it may increase liquidity of the stock because there will be more potential investor in this company. Okay, all right? So basically, this is just a summary, and so I just go take a look at it. Now, next thing we move on is to the second chapter. Now, second chapter actually is I think is 16, chapter 16, or 15 or 16, I forget. This is about capital structure. Okay. So the question we try to answer is: does the financing mix, the capital structure of a firm matter? Can we increase the value of a firm by borrowing more or borrowing less? All right. So if it matters, then what determines the optimal capital structure? If it does not matter, then why does it matter? Right? This is the answer we try to get, right, from this chapter. This is part 1. This chapter is all about theory, and the next chapter look at the practical consideration of capital structure. All right? Now, all this is just what we're going to look at is the pie theory, the even earning per share analysis, the Macadamia and Miller model, the MMM model, proposition 1 and 2, with no taxes and with corporate taxes, all right? And then we have the Miller model, which is we add personal tax to the model and see what happens, okay, all right? Now this is just a review since we are just talking about all this, so I don't need to talk about it. Now one thing is, I will not use this assumption in this course. In chapter 18, they also talk about that formula. That's the beta of equity equal to beta asset plus beta asset minus beta equity, beta of debt times debt to equity ratio, 1 minus the corporate tax rate, right? In chapter 18. In chapter 18, they also talk about, hey, if we assume that, well, the beta of debt is 0, then what happens? And if assume the tax rate is 0, what happens? Well, this will be a very simple equation. Now, we would not use this assumption in this course, right? Because they try to illustrate that the equity beta increase with debt to equity ratio. But I don't know why. Just look at that formula, it's still the case, all right? Because this must be positive, tax rate cannot be more than 1, so no government will tax you more than 100% of what you earn, no way. And again, this is always positive. That means you would not borrow, because this related to the cost of debt, you would not borrow 10% to invest in an asset that expect to earn 5%. Doesn't make sense, all right? So therefore, this also be positive. So even without those assumptions, we can tell directly debt to equity ratio increase will increase equity beta because of the extra financial risk. All right? Now the reason why I do not want to make this assumption is, if we assume debt beta equal to 0, what is the cost of debt? Anyone? If you assume the debt beta is 0, what's the cost of debt?
Isn't it?
Yeah. Yeah, that's the risk-free rate, right? Because when the beta is 0, your left-hand side is just the risk-free rate. But in most of our calculation, our cost of debt is not equal to the risk-free rate. So if we assume that in here, but do not assume the cost of debt equal to the risk-free rate, we'll have inconsistent answers. All right? So that's why I don't want to use that. So in this course, I will never assume the debt beta equal to 0. Okay? Right, now this is a pie theory. The pie theory does not have all the MMM calculation. It just look at a pie or a pizza, whatever it is. All right? That is, no matter how you divide the pie between the two stakeholders, one is the shareholder, the other one is the bondholder. It's the same amount of food. All right? So that means in order to create value, the only thing you can do is to make the pie bigger. How? Invest in positive NPV project. The only thing as a corporation you create value for the shareholder is to invest in positive NPV project. Assuming, of course, assuming the market is efficient. All right? Okay? All right? So the pie theory said, okay, no, the pie theory just predict that, well, the value of a firm is just equal to the debt plus equity, and no matter how we divide, how we finance this company, how we distribute the cash flow between these two stakeholders, we still have the same amount of cash flow. That's the prediction, all right? So it has exactly the prediction as MMM without corporate taxes, all right? Now, before we look at MMM proposition 1 and 2 without corporate taxes, we want to illustrate the idea of financial risk, right? I keep saying that if you borrow money, you increase financial risk. But how? How do you increase financial risk? So let's look at a simple calculation to illustrate. That is, this is the current capital structure. Now we want some investors, they want to cash out, so they want to manage money back. So let's replace those equity by a new debt and see what happens, all right? And this EBIT and earning per share analysis is to show that when a company borrow money, it's exactly the same company, under same scenarios, it has a higher financial risk. Right? The standard deviation increase. All right? So this is the current capital structure. The company used $20,000 in the production. All right? And note that equity is, of course, the same as your firm value asset. Right? That equity ratio is 0. You don't need to borrow money. And let's assume there are 400 shares outstanding. So the share price is the market value of equity divided by number of shares outstanding. So 20,000 divided by 400, that's $50 per share. All right? Now, under the new proposed capital structure, you borrow $8,000 and then you buy back $8,000 of equity. So after you buy back $8,000 of equity, the equity value will be $12,000. And the new debt to equity ratio will be 8,000 divided by 12,000, which is 2/3, right? And let's assume the interest rate is 15%. Now, what is the number of shares outstanding after the repurchase? Now, the price after repurchase, let's assume it's 50. Now, it's not necessarily 50. I don't prove anything here, but I can tell you later on we can prove that it must be 50. Because in this scenario, you do not create any value, you do not destroy any value. So the share price remains at 50. But later on we can prove that. But let's assume you know it remains 50. So if you borrow $8,000 and buy back share, how many shares you can buy back? Well, based on a share price of 50, 8,000 divided by 50, you buy back 160 shares. So you start with 400 shares, you buy back 160, so you have 240 shares outstanding. All right? So let's assume this is correct. This is the same first. Okay? All right? Now, let's look at what happened under 3 different scenarios. All right? In the first scenario, your EBIT, earning before interest and taxes, is 1,000. Second is 3,000. The third one is 5,000. And the interest, since we do not have any debt, interest expense is 0, and the net income is 1,000, 3,000, 5,000. So since we assume no taxes, right, no corporate tax, or for some reason you have a good tax planning, your tax rate is 0, so you don't need to pay any tax. Now, next we calculate earnings per share. 1,000 divided by 400, that's 2.5. 3,000 divided by 400, 7.5. 5,000 divided by 400. All right, that's the equity value divided by number of shares outstanding, give you the share price. All right, so it's 2.5, 7.5, 12.5. Now, what is your ROA? Now, ROA is based on your EBIT over your asset, or just firm value. So sometimes I write A in asset equal to value of firm, same thing, V, value of firm, asset. All right, okay? So in this case, if we look at the first calculation, the reception case, your EBIT is 1,000, your total asset, remember, is 20,000 here. So that's why we have 5%. All right. Next, calculate this is ROA. I'm sorry. Next, we calculate ROE, return on equity. So return on equity this time is your net income over equity. All right. So theoretically, ROA is EBIT over asset. So this is the asset we use to generate this cash flow. All right. So this is the whole firm asset. And the cash flow is the whole firm cash flow, before interest, before tax. Right? And this time, ROE is, well, what is the return on equity? We invest this amount of equity, and what is your net income available to shareholders? So in this case, net income is also 10,000, and equity, 20,000 as well. Right? So that's why 5%. Now let's just do another calculation for the expected case. Now for the expected case, this is 30,000, 30,000, I'm sorry, 30,000. and the total asset is 20,000. So this gives you 15%. Right? The ROE, the same thing, 3,000, and the equity is also 20,000. So that is also 15%. Right? Okay? And the last case, you do the calculation, get 25%. So you can see under the current capital structure using no debt, our ROA, ROE is from 5 to 25. Our earnings per share is 2.5 to 12.5. If you assume equal probability, 1/3, 1/3, the expected value is 7.5 earnings per share, 50% ROA, 15% ROE. Right? Okay. Now the second case is this time our new capital structure, proposed capital structure. So we have the same three scenarios, 1,000, 3,000, 5,000. Now this time we borrow money, we borrow $8,000 with an interest rate of 15%. So 8,000 times 0.15 give you 1,200. So that means under all three scenarios, we have to pay $1,200 interest. All right? So the net income for reception is this time negative 200 because 1,000 minus 1,200, you have negative 200. This is 1,800, this is 3,800. All right? Now let's calculate earnings per share. Now this time negative 200 divided by 240, not 400, because now our number of shares outstanding is 240. All right? So your earnings per share now in scenario 1 is negative 0.83 rather than 2.5. Now in the scenario 2, the same 7.5. 1,800 divided by 240. 3,800 divided by 240. Right? 1583. Now if you look at ROA, this time it is exactly the same. Exactly the same. Right? Because this is your EBIT, this is your EBIT, the total asset above 20,000. Right? Okay, so that means you get the same 5, 15, and 25. But this time, if you calculate ROE, if you look at the first one, your net income, your ROE is negative 200 divided by, this time, what is your equity? 12,000, not 20, because now you replace $8,000 of equity by debt. So your new equity value is only 12,000. So that's why you have this. Your ROE is negative 1.7%. Now the second case will be the same. So this time is 1,800 divided by 12,000, give you the same 15. And this is 3,800 divided by 12,000, you get 31.7. So you can look at all this number. The expected value will remain the same, right? Even you assume that equal probability. So financial leverage does not change the expected value. It just increases the volatility, the standard deviation. You have a wider range, all right? So that's why we said financial leverage magnify the business risk. Okay? So our business risk gives us a return between 5 to 25. With financial leverage, now your ROE becomes negative 1.7 to 31.7. So as a shareholder, now my potential return will be negative 1.7 to 31.7. So even the expected value is the same, but I have a higher standard deviation. That means I have higher risk. So I will require higher return to compensate for this higher risk. All right? Does it make sense, this calculation? Okay, now next, we move on the formal proof of the MFM model. So the first thing, they assume homogeneous expectation. Homogeneous expectation, that means everyone in this market have the same expectation. You expect their earning is 100, you expect their earning is 100, you expect their earning is 100. Everyone have the same expectation. all right? Homogeneous belief, all right? Second is we assume they have the business risk. That means they would not move into other business, or when we compare two companies, one unlevered firm, another levered firm, it is in the same business. They're identical, right? Okay? And the third assumption is perpetual cash flow. This is a crucial assumption in MMM model. You assume the company will have exactly the same EBIT, exactly the same cash flow forever. So this is true for a mature company, all right? So they can just have exactly the same cash flow forever. Now, next assumption is a perfect capital market, right? Perfect competition, all right? So everyone, well, everything is every stock is priced as a competitive level, all right? And they assume firm and individuals can borrow or lend at the same interest rate. Now, this, you may challenge this assumption. Normally, companies that are big, they borrow money, they can borrow at a lower interest rate than an individual, right? But we are looking at a shareholder. Here, you invest in this company, so you own the share. So you can use the share as a collateral because the share owns the asset of the firm. So this is the same as margin trading, right? Because if you go to a broker and say, okay, I don't have enough money to buy IBM share, can I open a margin account? Yes, they said yeah, because IBM is a good company, their asset value is very, very solid. So you can have, let's say, 50% margin. So if the price is 100, you only need to pay $50. So they lend you $50 to buy $100 value of IBM share. That's a margin trading. So you open a margin account. So the interest rate they charge you, again, is very, very low because you have the stock, right? You cannot withdraw the stock and take out the share and sell it. They keep the share in your brokerage account and you put down $50, right? So the broker will not lose any money until the share price drop by 50%, right? If the share price drop by 50%, they will give you a margin call or they sell your stock and recover the loan. So in that case, their interest rate is very, very low, right? So this is kind of reasonable to assume company and individual, they can borrow or lend at the same same interest rate, not risk rate, the same interest rate, all right? Now, next thing is no transaction cost. This is, again, important assumption because no matter how you buy or sell, you don't need to pay any transaction cost, no commission being paid, all right? And another thing is no taxes. Now, later on, MMM released this assumption because they know in real life, tax is something you cannot avoid, just like death, all right? So you have to pay tax, okay? And now, why we look at assumption? Because they are the important requirement. The model only valid with the assumption. Without those assumptions, the model is only an estimation. So that's why when you apply the model, you have to keep this in mind. Keep this in mind, whether the assumptions are valid. If they are valid, then you can 100% sure to use the model. But if the assumption they are not really that valid, then you have to use the model with caution. Actually, in real life, all model is just a starting point of a decision, not the final decision. Never, never, never do a model calculate, oh, this is the number I should use. Never. The number you get is only a starting point because all models have their own assumption. The assumption may not as valid as in their world. In the real world, it may be different. So this is a starting point. You may adjust the number because you have to put practical consideration in it. All right? So this is the assumption of the MMM model. Now, they try to prove this MMM model by using a very simple company, a firm U and a firm L. Firm U is an unlevered firm. That means they do not use any debt. Firm L is a levered firm. They use debt. All right? So this is the future cash flow, and this is a future current value. Now, for this one, is unlevered firm, So if they don't have any debt, so that means they don't have any cash flow paid to bondholder, so that's zero, right? Interest to bondholder is zero. And all earning before interest and tax will go to the equity, right? So that means each period they will receive this money. Now the total cash flow for the firm is the same as even because the sum of these two. Agreed, right? Now to find the value of the debt, we should discount the cash flow with the cost of debt, right? Because these are the interest. Remember, they are interest paid to the bondholder. We should use the bondholder required rate of return. So since there's nothing paid to them, the value of debt is zero. Now, next to calculate the value of equity. Now, we pay everything to them, so we should use their shareholders' required rate of return. That means we should use this, their required return. All right? Now, we define this is equal to our naught or our A as well. Because remember, when there is no debt, so this is a special case. This our naught is the required return of the shareholder when there is zero debt. So that's why we have this zero here. So this is the same as the asset risk because there's no debt. Remember, if you draw the diagram on this side, this is your asset and this is your equity. There's no debt. So the required return of this is the same as required return of this. All right? Because there's no debt. If you have debt, then you have debt to equity. So that's why we have to calculate the weighted average cost of capital. All right? Okay, so that's why this is the case. All right? Now, this is also equal to the WACC. Because when there's no debt, the weight for equity is just 1. The weight for debt is 0. All right? So this will give you the X, the value. Or in this case, SU if you want. Now the last one is a total, the EBIT. So this is this EBIT here. This is the cash flow for the whole firm. So we should use the firm WACC to discount it. So this gives you VU. And since we know these two are the same, so that's why I said these three are the same. Right? Because you can see, well, the value of another firm must equal to the value of its equity because it has no debt. Right? To calculate VU, it should be the present value of the cash flow using the whole firm discount rate, which is WACC, because this is the cash flow for the whole firm. Right? Okay? This is the cash flow to shareholder. We should use the shareholder required return, which is RX. But in this special case, RS also equal to our WACC because there's no debt. Right? And we also define a special number for this is also our naught, the required return of the asset. So this is the left-hand side. Right? So this is perpetuity formula. This is perpetuity formula. This is perpetuity formula because we have perpetual cash flow. Okay? Now next we look at the other side, the lever firm. The lever firm, this is the cash flow to the bondholder. All right? It is the cost of debt times the market value of debt. This is the interest payment. All right? So we discount using their required rate of return. So that's why it's equal to B. Now to calculate interest payment, you have to be very careful. There's two ways to do it to calculate interest payment. Either use the cost of debt and the market value of the debt. Or you can use the coupon rate times the face value of the debt. The two should give you the same interest payment. Okay? Because this times this is the interest payment, the face value, times the coupon rate give you the interest payment, and we discount the interest payment using the cost of debt, give you the value of the firm. So that's why if you move this to the other side, so that's we have this. Okay, because we have perpetual debt, the debt lasts forever. Okay, so this is your per period interest payment, each period coupon payment, the coupon rate times the face value, and we find the present value discounted using the cost of debt, the required return of the shareholder of the bondholder, I'm sorry. All right, and give you the market value of the debt. So to find the interest payment, you either use this or this, but never use B and little c, R, B, and F. No, never. Either use both market value or both book value. Okay? Now, next is to determine what is the firm of the equity value. So now it is an EBIT minus the interest payment. So this is the cash flow to shareholder. And now we should use this to discount, give you SL. Or sometimes we just use S. Now this SL is not equal to our, it is not equal to this. No, right? R not equal to RS only when there's no debt. But here we have debt. RS will be higher because now you have financial risk. Shareholder will require higher return of the extra financial risk, right? R naught is when there's no financial risk. You only have a business risk. So shareholder require R naught or RA. Okay? And the last one is for the firm, we have this is the cash flow of the whole firm. Then we should use a whole firm discount rate, which is our WACC. So that will give you VL. Alright? And of course, when you add them up together, you should have B plus SL equal to VL. Alright? Now, M&M proved that capital structure doesn't matter if there's no corporate taxes, based on this example. Because if you look at it, the two companies as a whole, they have the same cash flow in the future each period, right? For unlevered firm, you have the total firm, you have EBIT. For a levered firm, you also have the same cash flow. If they have the same cash flow, they have the same business risk, because I said they are identical, only difference is capital structure. So if they have the same cash flow each period forever, they should have the same present value today. Because they have the same risk, and they have the same cash flow, they should have the same present value today. If not, then you have an arbitrage opportunities. You can make money without any investment. That's the M&M argument when there is no corporate taxes. All right? So they argue, well, this is just using a diagram. That is, this is when there's no taxes, no debt, using R naught. Right? This is a special cost of equity. When there's no debt, you get this. All right? When the company used debt this time, you use this to discount it. All right? Okay? And they argue since they're the same. So if you look at this diagram, look at this one here compared to this one here, right? Or this one, right? Because this is the same. All three are the same. So since they have the same, must have the same value today, right? So MM argument is, okay, if let's say VU is greater than VL, then you have an arbitrage opportunity. How do you arbitrage? Always buy low, sell high. If you buy low, sell high today, you pocket the difference, right? You pocket the difference. So let's say, for example, if VU is greater than VL, then we should buy low. That means we should buy VL and sell VU. So today you should have some positive cash flow today. But your future obligation will be 0. So you can see here, you buy the whole SL, right? And you buy the whole U, firm U, right? SU. And you buy, since you buy the whole firm, so you buy the equity, you buy the debt. Now, there's no law from stopping you become the shareholder and bondholder. You can be a shareholder and bondholder of a company at the same time. That's completely legal. All right? So you buy all the share and you buy all the bonds of the firm L, all right? And you sell, short sell, SU. Now short sell means you sell something you do not own. You borrow the share from the friend. Let's say you know the owner. They say, okay, can you lend me the share? So you borrow the share from a friend, sell it in the market, right? When you sell it in the market, and that means you owe your friend the cash flow because he's supposed to receive the EBIT every year. So what you need is give them the EBIT every year. Or you buy the share back and return it to him. All right, so you may buy it back in the future at a low price and you make money. So that's short selling. All right, okay? So if you look at, sorry, look at this number here. You buy this firm, so that means you will receive this every year. All right, because you own 100% of that, you own 100% equity. So each year you receive this even. Now you short this company. So as I said, you owe your friend this cash flow every year because your friend is expected to receive this cash flow because he is a sole owner of you. All right? So every period you have to give them this amount. So what happens is in the future, you own this company because you buy VL, so you receive this, and you give this to your friend. So your net cash flow in the future is 0. So every period in the future, you don't need to worry about it because you get EBIT from L as a total because you own 100% of share, you own 100% of the debt, and you use this money to pay your friend EBIT. So in the future, you don't have any obligation. But today, you get a profit of the difference between the two. So this is positive. All right, so this is an arbitrage profit. So what it will do is, if you do that, the price of L will increase. When you short, the price of U will decrease. So the two will go to the same level at equilibrium. Okay? Any question about this arbitrage argument? Now M go further and say, okay, what happens if you do not want the company capital structure? Let's say they do not borrow money, but you want to invest in a company that borrow money. Or they borrow money, you want to invest in a company, you don't want the company borrow money. Now, you can create your homemade leverage. Or you can create a homemade unleverage. So that means, since there's no transaction cost, to buy and sell, there's no transaction cost. Now, you can replicate the cash flow of the other if you want. So in this example, now assume in this world, all companies, they are unlevered, right? They're all companies, they are unlevered. But you are an investor, you want some risk. You don't want, okay, I don't like unlevered firm. I want levered firm. But there's no such thing in the market. So what you can do is you borrow yourself. The company does not borrow, you borrow yourself. You create the leverage yourself. All right? That means you margin purchase. So in this example, if there's an unlevered firm, you buy the unlevered firm, but you borrow money to buy the unlevered firm. You create a homemade leverage. All right? So since the unlevered firm, you borrow money, $8,000, so you do the same thing. You just borrow $8,000. That means the company does not borrow, you borrow yourself. Since the assumption is individuals and corporation, they can borrow or lend at the same interest rate. So therefore, if you borrow $8,000 yourself, you have to pay the same 15% interest. Right? Since you own 100% of the unlevered firm, so you receive all the earnings because of 400 shares, because $2.5 per share earning per share, you own all 400 shares, you own everything. All right? But you pay the interest. So if you calculate your ROE is exactly the same as investing in a levered firm, right? Look at the second proposed capital structure. The second proposed capital structure said your ROE will be from -1.7 to 31.7%. So now you invest in an unlevered firm, but you borrow money yourself, right? You create exactly the same ROE. So that means company, you don't need to do anything. I can do it myself, right? This is the same argument as should a company diversify, right? Should a company diversify by investing in different industry? The answer is no, you don't need to do that. I can do it myself, right? Investor, shareholder, you can diversify. It's cheap, it's easy. Just go to the market, buy different stock. So company, you should not diversify for me. I can do it myself at a much lower price or cost, I would say. Right? The same thing, capital structure doesn't matter. Even you are a unlevered firm, but if I want a unlevered firm, I can create a leverage myself. I borrow money. So that's why we call it homemade leverage. All right? So now what you do is I try to match the equity or debt to equity ratio that I want. So the firm is 203, so I use 203. Right? Now, homemade unlevered, this time is the opposite. So let's say in the market, all the firms, they are levered firm. That means they borrow money. But I don't want that extra risk. I don't like financial risk. So what can I do is, well, I do the unlevered. That is, I buy both the equity and the bond of the company. All right? I become a shareholder and I become the bondholder. So this is the earning per share for a levered firm with a debt to equity ratio 203. So now if you own all the share, which is 240 shares, right? Remember, with the proposed capital structure, number of shares outstanding is 240. So now you own the whole firm, so this is what you get. But since you also own all debt of the firm, you receive a coupon payment of $1,200 no matter what. So this is your net income. So you divide it by your total investment, right? So it costs you $50 times 240 shares to buy L, and it costs you $8,000 to buy the bond. So the total investment is $20,000. So you calculate, yeah, this time I can get exactly the same return as investing in an unlevered firm. So this is the proof of MMM proposition number 1. Right? This is MMM proposition number 1. That is, firm value does not change. VL must equal to VU. Otherwise, there will be arbitrage problem. Now the second one is this equation. This is similar to the one you see earlier, but we do not have 1 minus t because there's no tax. Right? So they argue, well, because we are run out of time, so I will prove this equation next week. So if you want, you can take a look of it. And next week we will do